Very good, very good.
Yes.
Okay, shall we start? So today we are going to continue with episode 20 of Thrift Before You Quit. Last week we discussed about AI capital allocation, how AI can autonomously manage the wealth and what is the future of autonomous capital allocation. Tonight we will discuss about autonomous capital allocation and we will go deeper. For decades, investors believed the hardest question in finance was what should I buy? Institutional investors discovered a more important question: how much capital should go there? Buying is easy, allocation is difficult. Professional capital managers spend far more time deciding position size than choosing investments. Artificial intelligence follows the same philosophy. Position sizing, dynamic allocation, portfolio balancing, risk weighted exposure, opportunity cost, capital efficiency, adaptive allocation. If we take real market example, BlackRock portfolio allocation, Bridgewater risk parity, Yale endowment model. AI capital allocation engine works around cash reserve, opportunity scanner, risk engine, capital optimizer, allocation, continuous rebalancing of the portfolio. Capital never sleeps.
Voti Khapajanu.
Why institutional capital is continuously moving? Not because markets move, because opportunities move. Capital rotates between stocks, crypto, commodities, treasuries, cash, real estate, derivatives, liquidity pools. Institutional capital rarely sits idle. It searches for the best risk adjusted deployment. If we look at the real market inside, why Warren Buffett holds cash, why Bridgewater rotates macro exposure, why sovereign wealth funds rebalance. This global capital rotation revolves around cash, treasuries, equities, commodities, crypto, alternative assets, and cash. The science of portfolio balancing. Institutional investing is not about finding the next winning asset, it's about constructing a portfolio that can perform consistently across changing market conditions. Modern portfolio management combines mathematics, probability, and risk analysis to maximize long term capital efficiency rather than short term gains. So, modern portfolio theory MPT says that it builds portfolio that aim to maximize expected returns for a given level of risk through diversification. Efficient for Frontier represents the set of portfolios that offer the highest possible return for each level of risk. Sharp ratio measures how much return a portfolio generates for every unit of total risk taken. Sortino ratio evaluates returns by considering only downside volatility, focusing on harmful risk instead of total volatility. Beta measures how sensitive a portfolio or asset is to movements in the overall market. Correlation shows how closely different assets move together, helping investors combine assets that reduce overall portfolio risk. Diversification spreads capital across multiple assets or strategies to reduce dependence on any single investment. Risk adjusted return measures investment performance after accounting for the amount of risk taken to achieve those returns. Volatility clustering observes that periods of high market volatility tend to be followed by more high volatility, while calm periods often persist. Key takeaway of science of portfolio balancing is professional investors don't build portfolios to maximize returns alone, they build them to maximize risk adjusted performance, resilience, and long term consistency across every market cycle. For example, portfolio A has 100% Bitcoin, portfolio B has 40% Bitcoin, 30% gold, 20% equity, 10% cash.
Ví dụ
Why
như
institutions often choose portfolio B? Risk versus return curve. For efficient frontier, there must be balance between risk and return. Balance comprises of conservative assets, balanced portfolio, growth of assets, aggressive assets that leads to efficient frontier in the risk versus return curve. Why Rift Auto Engine follows the same philosophy? The auto engine isn't trying to predict markets. It is trying to keep capital participating. Participation is greater than prediction. Institutional funds diversify strategies. The auto engine diversifies participation environments. With alpha flow, growth participation, broad market cycles, smart flow, balanced deployment, adaptive allocation, core participation, micro flow, precise participation. Shorter cycles, frequent rotation, not one strategy but multiple participation frameworks. Now let's do real comparison. Traditional investor, one strategy, one outcome. Institution, multiple strategies, diversified participation. Auto engine, alpha flow, smart flow, micro flow, unified capital framework. Three flows. Why three flows? Alpha flow for large opportunities, growth, smart flow for balanced allocation, micro flow for precision opportunities, and together all uh, generate continuous participation of smart portfolio. AI doesn't replace traders, it replaces repetition. Humans define objectives, machines execute. Humans provide judgment, machines provide consistency. The future is human plus AI, not human versus AI. For example, BlackRock, JP Morgan, Goldman Sachs, Morgan Stanley. Intelligent participation framework includes human that sets goal, values and intent followed by the strategy that is defined according to the risk appetite and parameters. AI, which analyzes data, detects opportunities, and generates insights. Execution, which is AI powered execution with speed, precision, and discipline. Monitoring, real time monitoring of positions, risk, and market conditions. Optimization, continuous optimization to improve performance and efficiency. Human oversight is also important, which ensures accountability, alignment, and long term success. Artificial intelligence has fundamentally changed one aspect of finance.
và AI đã thay đổi hoàn toàn một cái khía cạnh của tài chính.
It no longer asks which asset will perform best. Instead, it asks how should capital continuously adapt. This is exactly why institutional finance increasingly revolves around infrastructure rather than individual trades. Yet, allocation is only one layer. The next evolution is even more significant. Artificial intelligence doesn't simply allocate capital, it learns from capital. Every trade, every portfolio, every risk adjustment, every allocation decision becomes data, and data becomes intelligence. AI is only smart as its data.
Và AI chỉ thông minh mà khi có dữ liệu tốt.
Artificial intelligence does not become intelligent by itself. It becomes intelligent because someone teaches it. Artificial intelligence does not make decisions from intuition. It learns from data. The quality of decisions depend entirely on the quality, accuracy and depth of the information it receives. In finance, AI requires years of historical market data to identify patterns, measure probabilities, and continuously improve its decision making. Poor or incomplete data leads to inaccurate models and poor capital allocation. Type of financial data AI learns from: price data, historical real time price movements; volume data, the amount of buying and selling activity; order book data, live buy and sell orders showing market depth; Liquidity data measures how easily assets can be traded without affecting price. Portfolio data, capital allocation, asset distribution, portfolio performance. Behavioral data, trading habits, decision patterns, market participant behavior. Risk data, volatility, drawdowns, correlations, exposures used to manage portfolio risk. Key takeaway: AI doesn't predict markets by guessing, it learns from structured financial data to make more informed, probability based capital allocation decisions. How ChatGPT learns from text, how AlphaGo learned from millions of games, how financial AI learns from millions of trades. What AI learns from? Market prices, trades, order book, risk, portfolio history, behavior, capital decisions, learning models. AI learns patterns, not predictions. Why trading books matter? Most retail traders think a trading book is simply I bought Bitcoin. Institutional firms see something completely different. Institutional firms see something completely different. A trading book contains position sizing, portfolio weight, risk allocation, entry timing, exit timing, leverage, exposure, correlation, diversification, drawdown, capital utilization, participation history. The trade itself is one line, the trading book tells the entire story. If we look at real example, Goldman Sachs, Citadel, Jane Street, Bridgewater, every institution manages trading books, not trade screenshots. Inside a modern trading book, there is capital allocation, position, risk, exposure, adjustment, performance, and history. Professional investors analyze portfolios, not individual trades. Mirror wallets as learning infrastructure. This becomes highly technical. Every mirror wallet creates an execution history. Every execution history becomes structured data. Every data set teaches future infrastructure. Execution latency, fill quality, capital deployment, allocation changes, risk adjustments, profit attribution, drawdown behavior, portfolio evolution. Mirror wallets are more than execution engines, they become financial learning engines. Mirror wallet data pipeline. Professional strategy deploys into mirror wallet, then there is execution history, then there is behavior data set, there is learning engine and infrastructure improvement. So mirror wallet is a data pipeline for the AI from smart money to capital identity. Now in the next session, we will understand capital identity. Now we will meet on Wednesday, and Wednesday I'm going to cover one bonus episode. Then we will cover probably episode 20 and finish episode 20. There is a new feature which is coming on Rift. So I can't wait to launch the new feature. So what I've decided, I will cover one bonus episode on Rift before you quit, and we will launch the feature probably this week. And by this weekend, I'm going to announce very big news on 3FO and Capital 3.0 also, both of them. So by Friday, we are making the tech ready, and by next Monday, the new strategy will be implemented in 3FO. Tech team is already working on this strategy. We are just rolling it out. I just need 5 6 days of hard work to implement this and give it to the all the teams. Yeah, especially for the Vietnamese teams, we are very concerned, and on request of you know your chief Kevildo, I have decided to implement this strategy as soon as possible to 3FO. So by Friday, I'm going to announce, and after announcement, Monday, this will be implemented. And the new feature on Rift will be launched also this week. Rift ecosystem is becoming more and more stronger day by day, and it is becoming more cohesive, more transparent, and bigger. Also, the web version of Rift app is ready. Once it is fully functional, we will release it to the internet. Then you will have the web version. You can access everything on a computer with Rift. Thank you so much, everyone, for listening, and I will see you all on Wednesday with the upcoming episode about new feature. And Friday we announce the news, and Monday we begin the implementation. And yes, everybody will be very happy. All right,
Thank you.
thank you,
Thank you so
thank you
much.
so much.
Thank you.
Come
See you.
on.
Thank you, see
Thank you,
you.
see
Thank
you.
you. See you.